Welcome to the London Property Podcast, your trusted guide through the complex and ever-evolving world of London real estate. We help clients manage, protect, and grow their property wealth by connecting them with the right expertise from finance, law, and tax to construction, design, and strategic advice. Through conversations with industry leaders, we bring you clear, practical insight into the trends, challenges, and opportunities shaping the market. Let's dive in.
Welcome to London Property. I'm your host, Farnaz Fazaipour, and I'm delighted to welcome back to the show Alan Kennedy of Trident Tax. Welcome back to the show, Alan.
Thank you very much.
Alan is kindly giving us his time again. We've got yet more tax issues to discuss that could affect high net worth individuals and their decisions around prime central London property. So today's conversation, Alan, is about the pensions coming in to inheritance tax from April 2027. Before we dig into that, just give us a little bit of an intro for some of our listeners who might not have listened to our conversations before, and tell us about yourself. And then I'll go ahead and dive right in.
Thank you. Yeah, so Trident Tax is a business that's been around for almost 17 years now. I left the large accountancy firm KPMG to establish the business. I think we're now 14 or 15 tax advisors. We're based in central London, Manchester and Birmingham. We do all kinds of advice for our clients who tend to be high net worth and ultra high net worth families, whether that's in relation to personal tax matters, corporate matters for their businesses, investment matters, obviously including real estate, and also their trusts.
And it's very important for people to have these conversations before rather than after, as you and I well know. I'm going to start by asking you to talk about the fact that so many people think that inheritance tax is only for the very wealthy.
Yes, it's a common misconception, but the amount of wealth that you need to have now to be caught by inheritance tax is really very low indeed. There is a tax-free band for everyone called the nil rate band, but it's only 325,000. And I think I'm right in saying it's been unchanged for possibly about 15 years or so. So with the effects of inflation, more and more people are sucked into inheritance tax every year.
Yeah, that date was 2009, I think, but it hasn't changed since. Even the property prices have obviously changed. Now, from April 2027, the pensions are changing. And can you talk to us about why, combined with what wealth you get from property, some people might be actually hit with 64 to 67% of tax if they don't start paying attention to this change?
Yeah, so it's obviously it's a classic government movement of the goalposts. So, people have worked in most cases for several decades to build up a pension pot, which they expected to pay income tax on if they drew the pension. But equally, with any money that they hadn't drawn at the time of their passing, that was always going to escape inheritance tax. So any financial advisor would tell their client, when you look at your wealth as a whole, the last money that you want to be using is your pension fund, because if you don't use it, at least that escapes inheritance tax. And the opposite, I'm afraid, will be true from April 2027. So people can be left in a really difficult position where they've got money in a pension plan. It suffers 40% tax because it's still there when they pass away. And then their children perhaps are going to draw that pension pot. Now, if their children are paying tax at the highest rate, 45%, then, you take £1 million pension pot, you lose £400,000 in inheritance tax. There's now £600,000 left. If that's taken by a higher rate taxpayer, then they'll suffer 45% on that 600,000. And effectively, you're left as a family with 1/3 of the money, which is a pretty sobering thought. So it's now driving behaviours where people perhaps want to access the pension pot a bit earlier and then give away other assets that they might own. And of course, that could include real estate.
I always like to try and be as positive as I can about things. And I always say, well, whenever a tax is introduced, there's a logical reason behind it. If you dig deep enough, can we come up with a logical reason with this one?
Well, the government's justification of it is that this is only going to tax excess pensions that are not actually needed. And they're saying that people are using pension funds essentially as inheritance tax shelters by putting so much money in them that they'll never need them. And I think the fundamental flaw, of course, in that justification is that no one knows how long they're going to live. And no one really knows what the cost of living is going to be in future. And the other argument against the government's position, of course, is there's no exemption from this rule if someone dies very prematurely before they've even had the chance to take a pension. So, how can you say that they've saved an excess amount for pension that they'll never need if if they have an accident or, they die very young? It just, there's no fairness about this, I'm afraid.
Right. Now, going back to the fact that the nil band rate has been frozen at £325,000 since 2009. So when it comes to London property, which, since that date, in some cases they've tripled, and then it goes up to 2 million and then it disappears after 2.35 million. Can you talk to us about that?
So what happens is if you're married or you have a civil partnership, then if your partner dies before you, and if you have a will that leaves everything to each other, which people call mirror wills, then there'll be no inheritance tax on the first death. Now, a lot of people actually make the mistake of assuming that their partner just automatically inherits everything and there will be no inheritance tax, but that's not the case. So if a couple have children, for example, and they don't have the mirror will and one of them passes away, a percentage of the assets will go to the children, and that's the bit on which inheritance tax could be payable immediately, and that could force the sale of a property to pay the tax bill, for example. However, if they've done things correctly, if one passes away and if they've left everything to their partner, then that £325,000 nil rate band is inherited by the other partner. So they would immediately have £650,000 of a tax-free allowance when they pass away. Now, there's also something called a residence nil rate band, which is an additional allowance of £175,000 for each person, broadly on the family home. As long as that ultimately is inherited by the children or the grandchildren. But there is a restriction to that extra relief, which again is inherited by the surviving partner. So it could mean that you have 650,000 plus 350,000, so £1 million tax-free. But once your total estate starts to go over 2 million, that £350,000 allowance starts to be lost. And once you've got to an estate of 2.35 million, it's lost completely. So for many people in London, that nil rate band, that additional 350,000 never actually gets into play at all.
Oh, wow. That definitely doesn't sound fair.
Well, I mean, you could equate this to the personal allowance for income tax, right? So if someone earns more than 100,000, they start to lose their personal allowance. Once they get to 125,000, they get zero personal allowance. So, they would say it's progressive taxation. The more you have, the more tax you pay.
You're listening to the London Property Podcast. We help clients manage, protect, and grow their property wealth. If you find this conversation useful, don't hesitate to get in touch. Now, back to the conversation.
So let's imagine that a couple owns a £6 million London home outright.
Yeah.
And they've got £2 million in pension and have done no planning.
Yeah.
So what's the order of operation? What should they be looking at first, second, and third?
Okay. Well, I think the first thing is making sure they have the mirror wills. That's the very basic point. So that they don't have an inheritance tax bill on the first death. So that would be point number one.
So it's not automatic that your spouse gets it. You have to actually say it.
No, it's not. And if you don't have a will, you die intestate, and this is where the law will give, and forgive me, I've forgotten the proportion, but it's either a half or a third of the estate will be treated as going to the children. And that portion of the estate will be an inheritance tax liability on immediately, which obviously the family will not have planned for. You still need the family home. The surviving spouse still needs the pension. So that then makes life extremely difficult, because you may then need to borrow against the equity in the property to pay the tax bill. So that's easily avoided. So they've got £8 million estate between them. They'll only get 650,000 of a tax allowance, so they're going to pay 40% on the vast majority of this. So with the pension, it's quite a complicated decision to make. Do you start to draw the pension? You could certainly draw the tax-free lump sum, which is typically 25% of the pension fund. So you could pull £500,000 out tax-free. If that money's not needed, that could be gifted to the children. And as long as the person making the gift survives for 7 years from the date of the gift, then that will escape inheritance tax on their death. The rest of the pension fund, you could decide to take the pension over a period of time and probably pay 40% or 45% tax on that. And that's on the basis that you then perhaps spend that money or gift that money, but you're paying tax at 40 or 45 in an effort to save inheritance tax at 40, and then maybe save tax for your children in future if they draw the residue of the pension fund after the inheritance tax has been paid. But that's not a straightforward thing to do. So you might say, well, it's good to pay 40 or 45 now, then ultimately one day the family's paid 67%. But the children might not need to take that pension or what's left of the pension fund for a long, long time. Or the children might leave the UK and might not be taxed on that pension where they go. And also, the pension fund, don't forget, its investment growth is all free of tax. So if we took all the money out now and, let's say, paid 45% income tax on it, we're left with 55% of the pension fund. That will grow. And, that could, in the hands of the people who've got it, yes, we can find ways to invest it tax efficiently. But compare that to leaving 100% of the pension fund in to grow tax efficiently, free of tax completely. We will pay a lot of tax in the end, but we might still be left with more money. So a lot of this is to do with people's own financial projections, what their family situation is. So it's, there's a matrix of variables here that people need to take into account. We're having these discussions with our clients, and people have got very different attitudes towards it. For example, some people firmly believe we'll have a new government in, say, 3 years' time, and that this will be reversed. So let's not worry about it today. Lots of different views to take into account.
And that's changing from the current situation where your pension pot is tax-free, both from income tax and inheritance tax.
Well, no, it's not free of income tax. You could take 25% of it free from income tax. The rest of it you'll pay income tax on. But it is currently free of inheritance tax. So it is a massive change by the government, really with no warning. And, people have planned for decades their savings on the basis of what they're going to have and maybe what they're going to pass on to the next generation. And of course, that's been ripped to shreds by this, I'm afraid.
Gosh. And if you did take the 25% out that was tax-free, could you take an amount that falls below the 40% per year?
Yeah, you can certainly, if you can manage, your income, then you can make sure that you're only going to pay a certain amount of tax, but you might have the state pension, you might have salary. that make it impossible to manage the tax rate down to a lower level. Some people are looking at changing the beneficiaries of the pension pot so that it goes to the next generation, and maybe they start to draw the pension if they're old enough and they pay tax at a lower rate. So different people in the family taking it. I think the other huge point, of course, in your example, Farnaz, is the £6 million property and what can be done about that. Okay. So you could look at borrowing against that property and then gifting away most of the amount that you borrow. Now, there's a cost of borrowing, clearly, every year. But if you think you're going to survive 7 years, maybe not survive much longer than that, if you can get a good interest rate, you might feel that the tax saving you get at 40% is going to be less than the cumulative borrowing cost. That was probably something that was more viable 5 or 6 years ago than it is today. If you gift the property away completely, but you want to continue to live in the property, then you're no longer the owner of the property under the law, but for inheritance tax purposes, you've reserved a benefit in the property, which means on your death, it's still treated as part of your estate and it's still subject to inheritance tax. So the only way to get around that, if you're gifting the property away completely, is to pay rent to, for example, your children. Now, if you're quite elderly, that might be a viable thing to do, because, I don't know, if you're 80 years of age, you've got a £6 million property, you'll be able to tell me what it would cost typically to rent a £6 million property. What's it going to get, a 3% yield or something?
Yeah.
So let's say it costs 180,000 a year. Let's say there are 3 children, so they get £60,000 each before costs. And let's say they've all got modest salaries, so they all pay 40% tax on this. So we got 180,000, it's taxed at 40%, so that's £72,000 a year. That's what I would call the tax leakage. The person who's paying them is the parent. So 180,000 a year is coming out of their estate. That's money that might otherwise be taxed at 40%. So that might be neutral, might not be. But what we're saving by doing this is perhaps 40% of 6 million. So that's 2.4 million. So even if the net tax leakage is £72,000 a year, it would take over 30 years, almost 40 years, before we've paid as much in income tax as we would in inheritance tax. So if someone's got the ability to pay the rent to the kids, in certain circumstances it will work. Now, that works perhaps even more efficiently if it's a second property that the parents only use occasionally. Because then if they gift it to the children, the HMRC's guidance says that you won't be regarded as reserving a benefit in 2 circumstances. One would be if your children are your hosts. So if you go and stay in the property with your children, you can use up the property for up to 4 weeks a year, and you won't be reserving a benefit in it, and you wouldn't need to pay the children any rent. If you go and use the property without the children being there, they're prepared to ignore 2 weeks of use a year. So if you don't live in the UK, or you're only going to use it on a very limited basis, it could be very efficient to do this, because then you don't actually need to pay any significant rent to the children at all. Similarly, if the children are renting it out, perhaps on an Airbnb basis or a holiday rental basis for the rest of the year, and it's only available to the parents when they do rent it, then they're only going to have to pay the rent for those particular periods that they're using the property. And suddenly it becomes, if they can't afford to pay full-time rent, if they're only paying a few weeks a year, suddenly it becomes a much more viable option. We do need to consider capital gains tax when we're giving things away. So if it's the main residence, parents can give it away If it's always been the main residence, there's no capital gains tax. Good. But if it's a holiday home, there will be capital gains tax. So the cost of that would need to be explored before we decided to make a gift.
So there's no way of giving away 75% of your property to your children and using a quarter of it.
Yeah, that can be done. That can be done. You could gift away a proportion of it. There's also an ability, if your children are going to use that property themselves some of the time, is to give away a designated proportion of the house. So if they have, for example, a bedroom dedicated to a particular child, they don't need to use it on a full-time basis, but then that can also represent a partial gift and then a partial reduction of the IHT exposure that doesn't involve the payment of rent by the parent for the part that they retained.
Right. And sort of related to this subject, but it was a question I was asked the other day, because what we do is at London Property, we try to help people manage property wealth by looking at everything, not just transactional advice. And we've got a client who's inherited a property, and the market is not one in which they could be selling that property. So I was suggesting that since it's now, all the probate stuff is finished, maybe they can put it into a company name because there's 3 children, so sort of kind of like an incorporation relief. And then that way they can raise money against it, hold on to the property, and then they'll be in a better situation because they can deduct their interest payments from the income. So is that such a thing? So when your parents has passed away, you've got the 3 children, does it have to go in their 3 names, or can they go into a company name after that?
Okay, so there's a problem with transferring a UK property into a company, which is that even if no money changes hands, the company is treated as buying the property at market value. So the company has to pay stamp duty land tax.
Even if it's coming from probate finishing?
Yes. So
right.
that's a problem. And as you know, there's a 5% surcharge on the whole of the purchase price if you're a company buying a property. So in this situation, I think it might be better if we are still within 2 years of the death. If the parents prefer not to inherit, they can do something called executing a deed of variation. And this can be done within 2 years of the death. And effectively, you can renounce fully or partially your inheritance, and you can ask for it to be redirected somewhere else. Now, often that's redirected to a trust, but it could be redirected to the children. Now, there isn't a stamp duty land tax cost in doing that. You would end up, however, in a situation where children own it directly. Children under the age of 18 are not allowed to own property, but we've certainly had legal advice in the past that although they can't hold the legal title, they could hold the beneficial ownership. So it could be held in legal title elsewhere, but on a nominee basis until they reach the age of 18. If it was rented out, the rental income would belong to the children, even though they didn't have legal title to it. But the deed of variation is a very good method of skipping a generation where the parents don't need the asset and they don't want the IHT problem of then gifting it away and having to survive for 7 years at some point in the future, maybe. And if they gift it away in the future, it may have increased in value and they'll have a capital gains tax bill. Whereas when you're redirecting on death, everything is rebased to the value at the date of death. So there shouldn't be a capital gains tax liability on the redirection of the property via the deed of variation. So that's something that we would look at there. If the parents wanted to be involved, it could be a partial share of the property that went to the children via the deed of variation. We could form a family partnership with different rights for different members of the partnership that suited their objectives in terms of the income profit shares, but also the rights to capital.
Right. If I've understood this correctly, so we're talking about the inheritors. So effectively, it's the grandparents have passed away.
Yes.
Their children have inherited the property, but there's 3 of them. They can't put it in a company name for incorporation relief at that stage without triggering stamp duty. but they can gift it to their own children so that they don't have to worry about the 7-year thing later.
Yeah, effectively they're redirecting, and it's not subject to the 7-year rule because it's never become their property. And I think just on company incorporation, it's worth mentioning that in corporation relief, the rules have just been changed. So it used to be if you did qualify for it, it was automatic and you didn't need to make a claim. The legislation has changed, so you now do need to make a claim. Now, when it comes to property, if you've got a property business and you want to incorporate to become a company, and as you say, Farnaz, the benefit of that is if you've got borrowing, the company gets a tax deduction at the same tax rate that it'll pay on the rental income. Whereas for individuals, we're 40% taxpayers or above, they get taxed at 40 or 45 on the rental income, but they only get a tax credit at 20% for the interest, which is unfair. So you could be making no money at all and still have a tax bill, which is ludicrous. That doesn't arise with companies. So there's a great attraction for that reason in incorporating. But what's often overlooked is that to qualify for incorporation relief, the case law and the view of HMRC is that you have to be actively working in that business for 20 hours a week or more. And if you've got a single property, unless it's a huge block of flats that requires a lot of work, you're extremely unlikely to pass that test. And even if you've got a handful of properties, you may not pass that test. So that's one point about incorporation relief. The other point associated with that is that unless you have a functioning partnership before you incorporate, you do not get relief from stamp duty land tax when you move the asset into a company. So you need to have a proper functioning partnership. And if the property left the ownership of the company within 3 years, it would be a clawback of the stamp duty land tax relief. So those are two very important things that unfortunately seem to be glossed over sometimes when people are getting involved in tax schemes, which are quite notorious, that we've all read about in the press.
So I think the conclusion is speak to Alan. Don't make any decisions until you've looked at your own personal circumstances, what you hope to achieve in a succession planning. And you've got till April 2027 to actually do something, because if you don't, you could be exposing yourself to 67% tax on death.
Well, not quite on death, but in the long run, yes. I mean, that could happen. And I think it's 64% if the people taking the pension are 40% rather than 45% taxpayers. So, it's a lot of money. There's no sign of a U-turn on this by the government, I'm afraid, because they take the view that, this affects, quote, rich people. So don't expect any changes from this government. But, it's a complex decision to take. It's not a very simple matter of let's take everything out of the pension fund, I'm afraid. There are things that pension funds themselves could do to qualify for at least 50% relief from inheritance tax. So they could invest in trading company shares that would get them 50% relief. And that could be, for example, a portfolio of AIM-listed companies. Now, lots of financial advisors don't like that because they say it's too risky. And I'm not a financial advisor, so I can't comment on that. But even, with the money remaining in the pension fund, there may be things that they can do to at least mitigate the problem.
Well, thank you so much for your time. And I think, again, this conversation shows me even more and more that when you are making decision about your wealth and property wealth in particular, there's so many different elements that need to kind of work in conjunction with each other. You can't really make decisions in isolation. And that's something that we noticed when we actually surveyed our members. And, over the decades, we've built up a pretty substantial database of high net worth individuals. And at least 50% of them said that, they didn't have one person that they could call who could kind of look at overview of their whole situation and then make sure whatever decision they're making in finance is in line with law and tax and all the other parts of it, which is what we try to really achieve here at London Property. So I'm very grateful for your time that you keep giving us. And hopefully I don't have to speak to you again very, very soon, because there's been yet another tax change. But this particular one is actually going to affect the locals a lot more, because all the tax changes we've been discussing up until now is made people actually leave the country who were maybe, connected to other places before coming to the UK. But this is really hitting home.
Yeah, it is. And I think, just on that point of people leaving, there is, some people have the misconception that if they leave the UK, even though they still own a property here, that they're not liable for inheritance tax. But I'm afraid the answer is that any UK asset is always exposed to inheritance tax, even if the person concerned has never even stepped on UK territory in their life. So, a great sort of misconception about this, and also, as you'll be aware, Farnaz, since 2017, if you've owned a UK residential property through an overseas company, that attracts an inheritance tax charge, even though the person doesn't own the property directly. They own shares in a company in Jersey or Panama or wherever it might be. If that person passes away, there's going to be an IHT bill at that point. So they mustn't lose sight of that either.
So succession planning is more important now than ever, I think.
Yes, it is. The government wants more and more of our money, and they're finding more and more ways to do it. So the picture continues to get more complex on a year-by-year basis, and therefore the earlier people look at these issues, the better it's going to be.
Yes. And the more the government pay out instead of collect an income tax, the worse our situation gets. So let's hope they start encouraging business instead. Thank you very much, Alan. And I look forward to seeing you soon, and have a great day. Thanks a lot.
Thanks very much, Farnaz.
Thanks for listening to the London Property Podcast. If you'd like guidance on managing, protecting, or growing your property wealth, get in touch. We're here to help. And if this episode proved valuable, share it with someone who takes the market seriously, and make sure you're following so you never miss an update.